Hello and welcome. I'm Vijay Srinivas. This Independence Day, here at the Federal, we're discussing the freedom that goes beyond your flags and fireworks, but lets you live your life on your own terms, the financial independence. And joining me to discuss more is Mr. Chokkalingam, who's the founder of Equinomics Research. So thank you very much for your time. And very happy Independence Day as well. How do you define financial independence? We've been long talking about this concept. Is it about assets or is it about, income or is it about time? How do you define this?
Very interesting. Before that, happy Independence Day to you. Uh, Financial freedom is ultimately asset only. Income is a means. So you have to make a lot of income. Ultimately, you have to make a lot of assets to sustain yourself. Even if there is no income or you retire, that should help. So it is only the asset ultimately.
Okay. So many Indians have aspirations, but there is a lot of debt and financial distress, right? So what's the biggest mindset change that you think Indians should adopting right now?
They should invest properly.
Uh-huh.
And a lot of people ignore equity. Even
Okay.
if they come temporarily, they get a bad experience and then they run away from the equity asset class.
Mm-hmm.
In India, only two asset classes, real estate and equity.
Okay.
These are the only two which can make a lot of wealth in the long term.
Mm-hmm.
So they should, and real estate, a lot of issues in terms of liquidity. So everybody should focus on equity to make, to get obtain financial freedom.
So many Indians have, huge financial difficulties. They're stuck in debt and all that. So how do you think, what kind of mindset change that you think Indians should be adopting to sort of, achieve this financial independence?
Yeah, two things. One is a prudence.
Mm-hmm.
While spending, they have to be very, very cautious. You should not go for a credit card and end up with spending more than income and end up paying 17-18% interest. If you continue that, you will never make a lot of saving and ultimately you will miss the wealth. The
Mm-hmm.
second way to get the financial freedom is that you shouldn't avoid equity asset class,
Mm-hmm.
because in this country only two asset classes, real estate and equity, which have given a phenomenal wealth. But for middle class people it is always difficult to make wealth in real estate because
Mm-hmm.
of the lumpiness and illiquidity, whereas equity, there is no lumpiness thanks to demat and you have a lot of liquidity. And just to add a point, in 93 the market cap was 2.5 lakh crore 1993. Right now it is 450 lakh crore, you know. So phenomenal wealth creation, but I don't know how many middle class people have participated in this. So
Mm-hmm.
one should not avoid equity asset class to make wealth in the long term.
If you really look at the India's wealth landscape, you see significant chunk of the Indian wealth is now accumulated within a very small portion of the Indian population. It's highly unequal society there. So but how do you see Indian economy's trajectory? It's evolving forward, sort of influencing Indian citizens' interest of accumulating wealth or wealth creation and all that.
Yeah, unfortunately, in many countries, you have this kind of skewed distribution of wealth.
Mm-hmm.
One cannot do much about it unless the economy becomes 5 trillion or $10 trillion economy. But however, there is a very good lesson to be made. You should avoid a wealth destruction to start with.
Mm-hmm.
So a lot of people invest in the wrong stocks, and those stocks get suspended or they destroy 90% of the principal. So that is a lesson to be made, that you should be prudent and you should avoid, destroying your wealth. The basic premises to make wealth in the equity asset class is to avoid the losses.
Mm-hmm.
So you minimize the risk. So
Mm-hmm.
properly researched or by going to mutual fund, you can always aspire to make wealth. But it, as far as a country level, it will take another couple of decades to change that skewed distribution of wealth, because that depends upon your entrepreneurial background, your inheritance,
Mm-hmm.
so on. But salary class, there is always limit how much to invest. But as I told you, market cap from 2.5 lakh crore, it has moved to 450 lakh crore in a matter of 35 years. If
Mm-hmm.
somebody has invested even small amount 35 years back, today it will be a phenomenal wealth.
That's right.
So therefore, equity instrument is one of the biggest secrets of making long-term wealth and jump into the rich class.
Okay, so you're extremely optimistic about the equity markets there, but what are the sectors that you certainly sort of prescribe for today's ordinary investors so that they can accumulate wealth in the longer run?
Uh, there are two ways the wealth is made in equity. As
Okay.
you rightly said, yes, sectoral approach. But that kind of opportunity always limited. It comes like a theme. 19
Okay.
early 90s or mid 90s, IT boom came. There was
Okay.
a structural change from $4 billion of export IT exports. Now today we are close to $200 billion. So 90s to 2015, you had a IT boom. So the IT sector, those invested made wealth. So the problem is that this kind of opportunity comes very rarely, and very few sectors give you this kind of structural change.
Okay.
So next structural change happened in telecom sector. Telecom stocks gave up. I mean, of course, the successful one gave up phenomenal wealth. Now recently, the e-commerce company. So this kind of opportunity comes once in a blue moon. You have to wait for that. You have to understand the economic structural change happening and which sector is going to be forward in that structural change. The second way, simple way, forget a sector, you pick up a excellent small and mid cap stock based on four criteria:
Okay.
quality of management, quality of the balance sheet, durability of the business model, and valuation comfort zone. And there are several hundred examples in the last 20 years. Those who based on these parameters picked up the right small and mid cap stocks, they made phenomenal wealth. So these are the two ways one should keep in mind for creating enormous wealth from the equity asset class.
We also see a lot of, as we talk about equity markets, a lot of volatility right now because of the Trump tariffs and other, macroeconomic conditions. You see volatility as some kind of an opportunity, or is it a threat to financial independence?
Volatility helps in two ways. It helps you to learn your mistakes. It also helps you, get an opportunity. But unfortunately, what happened, in the last 1 year alone, 4.5 crore new investors have come in. The BSE took 145 years to get 4.5 crore investors, but now it is 22 crore investor base. Only in the last 10 years, more than 17 crore new investors have been added, particularly after COVID. So that happened because of the boom in the market. But then what happens when market crashes? There is a dullness. People stay away from the market. So what one should learn is that volatility is part of stock market life. Roughly in 3 to 5 years, you always see one major volatility downward,
That's
big fall. You had a Lehman crisis, you had a 2016 deflationary conditions. In between 2010-11, you have Southern Europe debt problem. Then you had a COVID. Again, last September to February, 100 lakh crore was wiped out from the market. So every investor should remember that once in 3 4 years, volatility will be there. There will be a major dip due to some external, and therefore SIP method is always a best method. So you should use that opportunity. So you should always reserve something for the worst phase in the market. So therefore it could be an opportunity.
If someone is starting from scratch today, what would be your practical roadmap for them to reach financial independence, say by year 2047?
Yeah. If you are talking about a salaried class, middle class, there is always a limit to saving.
Okay.
So the first thing is that you have to be prudent in saving your money, and second, if you are new to the stock market, don't venture into invest direct equity. Go to the mutual fund, reputed mutual fund. So you can confidently invest at least 20-30% of your savings, in equity mutual funds, and do through SIP. Today we are 450 lakh crore, and very soon we will be 1,000 lakh crore. It is inevitable. The growth of Indian stock market, it will create enormous wealth. So better to do is go to the mutual fund and invest. But of course, if you want to become a professional, you can always go for a direct equity, provided you are prepared to work to at least 2 hours in a day to learn and invest. So otherwise, you should go to mutual fund and invest 30-40% of your savings for long term.
Okay, but and that also comes to this question for young profession. What would you suggest? You think they should go in for safer instruments, or you think they should just take a plunge into the equity markets?
They should plunge into the equity market through mutual fund route.
Okay.
Because why I'm stressing is that a lot of people invest in select 2-3 stocks, and they destroy their wealth, and news driven, perception driven. Whereas mutual fund managers, normally they invest in 60 to 100 stocks. So the risk is mitigated to a large extent, and they are seasoned professional investors. So the young people simply plunge into the equity, but then never borrow money and invest in equity, whether direct or mutual fund. Never borrow money, because even the mutual fund can fail to give you absolute return. If you take a 2010 November and 2013 November, the Sensex came down from 21,000 to 16,000. So almost a vast majority of mutual funds gave a negative absolute return even after 3 years. So those things can also happen. It happened, once in a decade in this market. So never borrow money and put it in equity. It should be always your surplus money.
Okay, we talk a lot about equity markets, but if you really look at it, it's 1.4 billion people, but we less than 5% of the population are actually invested, are actually active in stock markets. What do you think there is a bit of a reluctancy? Not there's a huge amount of reluctancy in the Indian public.
Because last 20 years I've been in the public domain. I'm in
Uh-huh.
the equity market for more than 34 years, but only 20 years I've been, servicing.
Okay.
So what I personally learned is that, unfortunately, a vast majority of the new investors, they start investing in the direct equity purely based on the market news, market perceptions, through word of mouth. And I've seen even young professionals from technology investing in the bull market in last September, many stocks. I pick up a conversation with the fellow passenger in flight and talk. So they show on the handset, these are the stocks. I'm sorry to say, I'm not saying not all are doing this mistake, but a vast majority of the young new investors, the one blunder they do is that they invest aggressively based on the news flow perception. And I have interacted personally with many new investors and asked them what basis, what was a PE when you invested, what was a price to book value or EV to EBITDA. Nobody could answer. They have put in hard earned money, hard saving into the equity without knowing. It is like you are buying a flat, whether it is built properly using sand, cement, or it's only made up of sand. Without knowing that you are putting hard earned money. That is what the biggest problem. Unlike many other professions like a doctor, engineer, in equity profession, anybody can learn to execute the trade within half an hour. So this is the most important point I stress to all the new investors, that just because you can open the demat account, trading account in a day's time, and you can learn how to invest in an hour's time. Many people, I'm not saying again all, many young new investors, they think they have mastered the art of investing. So it is wrong. The art of investing comes after 5 to 10 years or even after 20 years. It's a long journey to learn and invest. So these few mistakes, if they learn, I think they can avoid a lot of wealth erosion.
Okay, for someone in their 20s and 40s and 60s, how does the meaning of strategy for financial sort of independence change?
If they are into jobs, you can invest quite aggressively, even 50% of your monthly savings in equity. As I said, again, go to the mutual fund. One can, if they have, I've known many doctors and engineers have become a full-time equity professionals, and the kind of wealth they made, I am sure they would not have made in their original profession. So there are a lot of people have shifted from their core profession to equity profession. Nothing wrong. So it's a very passionate thing, because this is one of the few professions. Throughout the life you sit in the AC room and make money, but provided you are good at research. Otherwise, you will have to come on road. So that also happens. So what I meant to say is that young investors in early 20s, 70, 80, 90%, they can put it in a mutual fund. If they are willing to learn about equity investment in the longer period, 10-20% they can invest in direct equity, and they can try to learn from the balance sheets, quarterly results. They can attend the AGM. They can read. Today everything is available, click of the button without paying. There are a lot of databases, financial performance over the years, quarterly, return on capital employed, everything. In Warren Buffett time, he used to spend several days together in a year to collect. But today, the people in 20s, they've got a fantastic opportunity. Just click of the button, they can get everything. So start the journey of learning in equity. Let me tell you again and again, stress this point. If you start the journey of learning equity, and then you accumulate your learning in equity, automatically the equity wealth gets accumulated. So the biggest mantra to attain financial freedom for young educated people: start your journey of learning in equity, and don't consider this as a investment process. Consider as a learning process, and go deep into learning. by the time you become 40, 45, you can definitely retire, because in the last 20 years, there are many quality Indian companies catering to Indian demand. They have created a phenomenal wealth. They have moved even 20 times. Here, there is a tire company in Chennai which has gone up from 600 rupees to 1,57,000.
That's right.
So the basic premise is, basic suggestion, start your learning, right learning.
Okay.
Don't succumb to the news driven, perception driven, social media driven. You take all the news flow, data points, but vet them out, analyze, understand, return on capital employed, period, valuation multiples. If you don't have interest or if you don't understand, simply go to the professional mutual funds. That is a way to make wealth.
One last question there, sir. What's this one habit that you think our viewers watching this particular program should be adopting on this Independence Day so that they can meaningfully do something towards the goal of achieving financial freedom the next 10 years?
Certainly. I mean, I have seen even the farmers losing money, without knowing anything, invested, what he sold the land. I met him in a workshop. He sold the land. His son, young son, engineer, came home and told him, you invest in this stock, it will double in a month's time. So he put everything, and this happened 7 years back. Even today, it is down by 70%. So don't try to make overnight wealth in the equity market. So contain your greed. Contain your greed. And have understanding that equity asset class can create wealth only beyond 2 to 3 years. If you are lucky, if you get in few days or few weeks. But that kind of journey, experience, actually, unfortunately, bad. It gives you overconfidence. It gives you overconfidence such a way that you pull back a lot more money and then burn it, and then for very long you suffer. So the basic lesson to achieve financial freedom: contain your greed, accept the fact that equity asset class will create wealth only period of 2 to 3 years minimum, and third, join this journey of learning in equity. If you are not interested, if you think you are not capable of doing it, go to the mutual fund, wait for minimum 3 years, and that's a way to achieve financial freedom.
Thank you very much, sir. Pleasure talking to you. Thank you.
My pleasure. Thank you.